Hi everyone and a very warm welcome. Government has no business to be in business. This is a statement we have often heard from civilians, corporate houses, and even politicians. From five PSEs in 1951, we have about 348 PSEs as we speak. There is a lot of divergence as far as the views on public sector enterprises are concerned. Some experts believe that there is a large value proposition. However, some deny holding it even as a part of asset allocation. To get some balanced perspective on this sector, I am joined in by our subject matter expert, Mr. Sailesh Raj Bhan. He is the Deputy CIO Equities at Nippon India Mutual Fund. He has a rich experience of about 24 years, and out of which 15 years he has been with Nippon. He is responsible for managing some of their flagship funds. Thank you, sir, for joining in, and I hope you, your family, and everyone at Nippon are doing well. So, let me first begin by asking you at a little macro level. So, if we analyze the public sector enterprises, they're mainly low risk businesses. Some of the companies, the dividend yields that they have given are close to twice that of the bond yield. However, in spite of it, we see gross underperformance as far as stock market returns are concerned, not just compared to the Nifty index, but also to a lot of other indices in general. If I were to ask you one single most important factor leading to this gross underperformance, what would it be?
See, if we just choose the single most important factor, I think it is more got to do with the fact that the government itself has been offloading a lot of equity, right? And because of the fiscal requirements and all that. And in an environment where growth generally in India has been muted, if you look at it, even the outperformances in the marketplace have come in very select sectors in the last 3-4 years. It's not been a broad-based outperformance, right? And alongside, when you have a large amount of selling which happens in a select set of stocks, and where their earnings of those businesses are weaker, the impact on stock prices or the overhang on stock prices is large. So that, I think, is one fundamental factor. Second is some of these businesses are also uh, uh, built over a period of time, have a little bit of a traditional element. They are not in the businesses which are more tech oriented or more oriented towards the future. And a lot of money has been chasing the new category of businesses because clearly markets are getting redefined, businesses are getting redefined. Agility of businesses also matters a lot in terms of gaining longer term profit pool gains, which companies can deliver. So I think it's been a combination of these two reasons. But first, primarily, is also part of significant amount of equity sell-off which has been happening in public sector businesses over the years, and in a weak economic environment that is impacting the returns to shareholders.
So let us come to specifics and address the PSE space from a BNB framework, which is business management and valuation perspective. Now, the primary owners of this businesses is the government. And if you look at a strategy which the management is trying to demonstrate, it often looks confusing to an investor or to an outsider. Sometimes they're talking about divesting, sometimes they're talking about recapitalization, at times there are high dividends which are being paid out. So my question to you is that in absence of a proper strategy or a roadmap, is this acting as a hindrance to the performance of these PSE companies?
I also mentioned one more reason why this challenge is there is because of the fact that uh, the underlying business conditions have also been weak. If you see, the economic growth we have seen last year at 4.5% is one of the lowest we have seen in a long time. And a lot of these businesses being associated with the core sector also face most of the brunt of a weak economic growth, right? So I think that has been one reason. Secondly, uh, uh, are are the measures which are like you mentioned, different signals being sent in terms of some of these businesses. Certainly it counts because as a shareholder, everybody looks at a signal from the larger shareholder in terms of what they perceive to do with their businesses. To be fair, there has been a significant amount of dividends which have been paid out by these large public sector businesses over the years. And these businesses have actually, despite whatever challenges, have been able to maintain cash flows. Good quality businesses have remained, or dominant businesses have remained robust. In fact, a lot of these businesses have not degrown earnings. In fact, they have done reasonably well. It is more that you generally have some pressure of sell-off, or you have, to meet the fiscal requirements, the government has to reduce stake at various points of time. And when there is an extra liquidity or selling happening, you have some such valuations getting impacted by companies. But I think this is a part and parcel. The longer this pain, the greater the opportunity, because end of the day, whether it's a PSU business or a non-PSU business, if it has a sustainable, it's a good company with a sustainability of earnings. So some of the utility businesses and all that definitely have sustainability of earnings beyond what we can think, right? And if they are available at reasonable valuations, where there is no visible cause for disruption in the shorter term, I think there is value emerging in all of these areas. So it's more got to do with good quality businesses within public sector, in my opinion, will continue to stand out irrespective of the near-term challenges, which, unfortunately, because of slower economic growth, you will have tax collections being lower, and, you have to fight to meet the fiscal targets. And in that effort, you have some sell-offs which have been happening, which do depress prices in the near term. This has now been happening for at least 3 years now.
My next question to you is on the scope of business opportunity. Now, if you look at how these companies were positioned, let's take the example of, for example, MTNL, BSNL, or Air India. All of them were run as monopolies, and they had a lot of competitive advantage when they probably started. However, with time, because of customer experience, seamless executions, etc., we started seeing private partnerships also coming in. And now we also understand that with COVID, a larger reliance has to be led on public-private partnerships. So, in this regard, what is your assessment for these companies? Do you think that their growth will be muted even in the times to come because of their monopolies being disrupted?
To this point, like I said, there will be companies who have competencies to survive and fight the marketplace. They may come in private sector or in public sector. I think those set of businesses will continue to gain market share and thrive. Within, say, a public sector enterprises, if you have businesses which are purely built on monopolies, right, and they are not competitive enough in an open market, right, then the loss of market share will certainly happen, because India has opened up to private sector significantly, and private sector now has resources, at least in the last 10, 15 years, to pump in and create. I've seen what happened in insurance, you have seen what happened in banking, you have seen what happened in so many other areas. There is capital available to win market shares and grow if run efficiently versus incumbents. And generally, incumbents happen to be public sector because they were the guys who were actually building India in the last 40 years, right, prior to this period of time. So this shift of market share is real, it is continuing, it is visible. But will this mean that it will only be a private sector market, or it will only be this? I think it is, I don't necessarily see that it is only a one-tier market. You will have opportunities in good quality public sector enterprises as well, who will also learn to fight this competition on the right with right kind of strategies, technology, and all that. In fact, in some cases, we are finding public sector businesses actually doing as well as private sector businesses in a lot of matrices. And their investments, especially in the last 10 years, towards improving technology and coming closer to what the real world desires, or what an efficient private sector world desires, is only improving. Where the businesses are failing is where there is complete disruption and those markets have evaporated. Like, for example, in the case of power equipment, where everything is shifted from thermal to other categories, and there are no new orders on the thermal side. You have businesses who are levered to that, or businesses who are levered to only landlines significantly, we're not so good in mobile. So a lot of these industries where there is a huge disruption, where the shift is not being able to, and with the shift is happening very rapidly, there you're finding these monopolies getting lost and getting impacted. But those who are competitive, those who have survived open competition for a long period of time, I think are only getting stronger, in my opinion. At least there are a select set of businesses which are within public sector also investing to make themselves relevant, make themselves, a few of them are leaders in their categories. They're reinventing and investing to be relevant and, growing. So I still find some entities in this will deliver substantially better returns to shareholders, whereas, like you said, pure monopoly-oriented businesses will suffer.
So we have discussed about businesses, we have discussed about management. My next question is about valuation. And here I would term a phrase which you often use, and we hear you talking about that on a lot of news channel as well, which is bankruptcy valuation. And that's a word which you always use. Now, we are actually confused because being students of finance, we always used to, track matrices like price to earning, price to book, dividend yield. And if we look at public sector enterprises today, price to earning of sub 10, price to book of 1 or sub 1, dividend yield of more than 6%. Is there actual intrinsic value in these companies, or is there a value trap which people are trying to avoid at this point of time?
See, it is again coming down to specific companies, specific companies and categories. In these, if businesses are looking for the future and are able to build up products which are relevant for consumers for the next 5, 10, 15 years, I think there is no value trap. In fact, their valuations are in your favor. So it's irony in the markets that, for the same companies, subsidiaries of those public sector entities are being getting way disproportionate valuations than the main entity, right? And this we have seen, you are giving a valuation for the huge distribution which, say, a large bank has to its subsidiaries, but you are not giving the advantage for that for the larger holding entity itself. Now, these cases are possible because the economic environment and specific asset quality issues have been there in the system, which are actually hurting it. But if you see a reasonable, normal operating environment, you will find businesses who have reinvested or invested well in competencies and capabilities should start getting their required and desired valuations. See, a PE multiple is not a reflection of, I would say it's not necessarily a complete reflection of, what a value of a business is and, and what it will do in the future. So a low PE multiple doesn't necessarily mean that it will be the best performing stock in the next 5 years. But a low PE multiple with a sustainable business on hand has a much greater chance to deliver above the market. And there are certain pockets in the market in public sector as well as non-public sector entities which are at bankruptcy valuations in sectors which are under stress today. Let me just highlight this point. The pharma as a sector, right? All private sector companies, right? You're getting large companies at 15 multiple, 12 multiple till just about 5-6 months back before this rally came about, right? So there are phases which are external in nature and there are phases and things which are internal in nature which impact these valuations. In my reading, there are a select set of businesses in public sector as always, and is also in the private sector, which today have valuations which are disproportionately low. And these are now lesser pockets than what they were before, but there are pockets still there and who have longevity and will come back and, kind of demonstrate and retain their market shares and, grow in the business. So those sets of businesses clearly offer a lot of potential. They are not value traps. There are certainly monopolistic companies which are value traps, which are not investing for growth in the future and their balance sheets are deteriorating because of receivable problems. They are there both in private sector and public sector. It's more visible in the public sector because these are large enterprises in public sector. And hence, everybody's can see those larger numbers and their multiples being lower. So there certainly is a combination of solid businesses at reasonable prices and some value traps also.
Now, I want to draw your attention toward one part, which is public sector banks. Now, there are two dimensions to the question. One is, on one hand, government keeps on recapitalizing these banks, and on the other hand, these banks keep on not generating any positive value for the shareholders. And then we see issues of efficiency in these entities, be it about underwriting skills of these banks, be it about technology embracement, or be it about growth opportunities which these entities are exploring. So, if I have to ask you specific to public sector banks, do you see a similar opportunity like you see in utilities in public sector banks as well, or you don't find much of a value in this?
Yeah, see, utilities is a slightly different sector because it is less disrupted, right? And valuable assets are created and they are actually not necessarily huge consumer facing businesses, but they are more asset intensive businesses and, hence they are slightly different from banks. Coming to the banking side, to your question on the public sector banks as well, if you see, if you just segment that, there are two categories of banks within public sector as well. One category which comprises some of the leaders there, one, two, three kind of players there, are well-run businesses. Uh, they are they will anyhow be impacted in any slowdown in the country because they have 25-30% or a very large part of market share. So if you are in India and you are virtually the lender of such scale and size, the whole economy has been weak for the last 3-4 years. You certainly will be impacted because you are a person who have 25% or 30% of India's deposits and 20% of all lending in this country, right? So it does not necessarily say that they are massively inefficiently run. It only tells us that yes, there have been challenges in the sector. If they were run better, maybe they could have handled it better. But do they have the ability to come back? They have the ability to come back strongly. Look at it. Some of these well-run businesses have created fantastic franchises in the same 4 years which we are talking about, or for same 5 years which you're talking about. You've created an insurance franchise, you've created a credit card franchise, you've created a general insurance business, you've created life we have talked about, and a lot of value creation has also happened in these pockets. So in my reading, you will have some segments like, for example, people who don't have an ability to generate a return on equity, even in a 4-5 year or a 3 to 4 year period, when things normalize in a normal economic environment, those are businesses which you should not invest in. And certainly these segments of businesses exist in a lot of public sector banks, because most of them don't have an, or at least the second tier, third tier of them don't have an edge or an ability to compete with the same private sector counterparts. So this loss of market share by second tier, third tier public sector banks is a reality which you need to be aware of. But leaders in those categories have come back pretty strongly, investing in digital and all that to be relevant. And some of these have a long way to grow over the next few years.
Right, sir. This one question is pertaining to what our investors always quote whenever we discuss about public sector enterprises with them, and the perception is that there is a lot of interministerial involvement which happens in these public sector enterprises, thereby delaying the decision-making process as well as execution process. So, do you think in a country like India, where we have created these mammoth enterprises over last 70 years, is there a possibility to have a structure like a sovereign investment arm which manages these enterprises so that at the end of the day, efficiency in terms of running these businesses and decision making becomes extremely fast? We do understand that these are diverse businesses and it would not be an easy structure to set up, but do you think that kind of a possibility is also there which can happen in the future?
Yeah. See, to be fair to public sector enterprises, there is a governance guideline or a framework under which they have to operate. Everything has to be accounted for. Every risk you take has to be explained. Everything has set procedures and things which are there, which does impact the efficiency and the speed and the turnaround time, which necessarily is not there in the private sector. When you talked about banks, if you realize, even private sector banks have stumbled in the last few years, right? And so you've had challenges everywhere. But you're right, there can be structures and efficiency improvement. In fact, a few steps have been taken by the government in getting some private sector involvement at senior levels in a few banks. And I think such measures can happen and allow for improvement in efficiency, because these assets are generally not easily replaceable. These are large enterprises with so much of capital invested and such low cost of operations they would have in a lot of cases. And their sustainability is very, very high. So I think there are many ways out to correct it. One way which you have suggested is allowing for or having a structure which is more flexible, more private sector like, and allowing for better capital allocation across the whole set of public sector businesses which are performing, getting more capital, and those are not performing, actually not necessarily getting to the next level and getting themselves reorganized. So these structures are definitely welcome, and I think some steps are being taken in especially if you see in banks, they were chairmen appointed from outside in a few banks, and technology, a lot of technology led. In fact, larger banks who had built very good technology capabilities actually helped and supported technology implementation in other enterprises. So a lot of sharing of knowledge and a lot of investment in uh, upgrading skills and all that is needed, and I'm sure it is continuing. And I think structures like this, which will facilitate faster decision making, are actually welcome, whether it is, like you mentioned, a sovereign holding company or something which is way more operationally aligned to the current economic realities, is a welcome change. And I think that will make a big difference to how these businesses are run, evaluated, and how much of energy each of these business can really bring out, when you let them fight in the open market to private sector competitors.
The point well taken. So my last question, and this is very relevant because what we have seen in India in last in our career of couple of decades is that India works well when there is a crisis, and to come out of crisis, there are certain decisions which are taken at a very short time frame than what normal convention in our country is. Now we have seen disinvestment targets being set up every year for last few years, but when it comes to strategic disinvestment, we haven't achieved much. Be it about flagship names like Air India or BPCL, or even announcement by the government in this budget about LIC. Now equity markets have improved. There is a lot of focus on Atmanirbhar Bharat. There is a change in defense procurement strategy. Do you think with these newer steps being taken and with government trying very hard to come out of this crisis in a positive way, these strategic disinvestment will pick up in near future and we will see more capital market participation as well as improvement as far as PSC companies are concerned?
So 2 points to this. Generally the divestment targets which have been set up by the government each year in the last 5-6 years were generally pretty ambitious at the start itself. They were large targets, 1 lakh crore. This time it was 2 lakh crores. A very large set of a target was set up, right? And there were some of it were and they were not met during the period for various reasons. I think the logic of getting strategic divestments back to the table, and like you said, crisis allows you to take these tough decisions. So allowing it to do, I think strategic divestments will possibly could be one single factor which can lead to a re-rating of all these public sector enterprises, which are good quality businesses within public sector. Not referring to all of them, but companies who have capabilities and competencies, because a strategic value for some of these businesses is way higher than what market values in these high quality businesses actually reflects. And we think the assets which are there today, which are up for divestment, which you all know and you've talked about, some of them have significant value for new entrants. Basically, if you come in via owning some of those large refiners and all that, you virtually get an entry which will take you 20 years to build in this country. So people can pay substantially higher than market prices when they choose to invest in strategic, when they choose to buy assets from Government of India directly on a strategic basis. And I think that's the right step forward, which will allow value to be created for even other listed enterprises, where there will be expectations that some strategic partner or value creation can come about, rather than only an equity sell-off or an offer for sale as a model. So I think strategic divestments are real. The effort which has been done, as we understand through engaging with the different authorities, is the fact that this is a very serious initiative, and obviously COVID has created some kind of setbacks in some of these areas. But I think strategic divestments are the way forward. They'll give you maximum value, and second, they will actually create, I would say, true value or true referential value to the other listed entities in the public sector side as well, which I think is an equally important factor, which I'm sure anybody who wants to sell their assets wants to consider that they have a fair valuation for their businesses in the stock markets.
So we really hope that happens, and that's a very positive statement to end our discussion. So that brings us to the end. And if I have to summarize our conversation, I would summarize it in 2 words. It's been mythbuster for us. Though we are participant in the market, but we had also got a lot of perception which got away or which got done with after discussing it with you. So few key takeaways for us. One is that we are just seeing the performance of these companies for last 3-4 years and making impression about it. But if we see there is a high correlation of these companies with our economic growth. And since economic growth has been slowing, we have seen underperformance from these companies. Second important point which you made, and which was very, very strong point, was that certain PSCs, businesses, a way of doing businesses is far, far superior than even their private sector counterparts, which is something which we never thought to be true. But coming from you, we believe that there is a strong merit in understanding that statement in very well details. And lastly, so the learning for us is that we shouldn't paint all the companies with the same brush. And there are companies in PSEs which have strategic value, which is far, far higher than what we are seeing in the stock market at this point of time. So these are the key takeaways from this. Thank you so much for taking out time on a busy day. And we really appreciate taking out such a long time and explain all these things in finer details. Thank you so much, sir.
Thank you, boss. Thank you very much for your time, and thank you for the very interesting questions, which cover a very wide facet. It's not limited to only one, what are the markets doing or whatever, but more fundamental questions were asked. So thank you very much for your time, as well as the insights which you were trying to bring in this conversation. Thank you.